In this video, we're going to talk about the new tax reform law that's just been passed and how that's going to affect you and your real estate purchases going forward.
I'm Randall Dolland, a licensed real estate agent, and I'm here to help you navigate the world of New York City's real estate market.
So in this video, we're doing a follow-up to our last video on tax reform. So we're back here with Josue Rivera from Rivera and Montes PLLC, and in our last video, the legislation had not yet been passed, but now it has been and is signed into law. So now we have the facts, and we're going to tell you exactly how this new tax bill could affect you and your purchases in real estate going forward. So Josue, thanks again for joining me and for giving some more information, to explain more about how taxes will affect purchases going forward.
Yes, Randall, thank you for inviting me. And as you mentioned, the last time we met, there were just proposals. Now, This has been final. The legislation passed in December, and the president has signed it. So this is what we call the law of the land. It's effective starting on January 1, 2018. So it's important to note that the tax returns that we will be filing in April 2018, those relate to the year 2017. So they are not impacted by this legislation yet. This is for the tax returns. The impact is for the tax returns that we're going to file in April of next year, 2019. And yes, there were, first of all, I want to stress that this impacts everyone. You, me, small business, large corporations, everyone gets impacted by this legislation. And first, I'm going to start talking about individuals, right? In the real estate market, what changes could impact or affect the decisions that us as buyers have when we go out to acquire a residence, right? And we take a mortgage.
Yeah, so, residence and other properties, investment properties as well.
Yes. Yeah. So first of all, tax rates. I just want to start a discussion with the tax rate. There are 7 brackets, individual brackets, ranging from 10% to a maximum of 37%. So before, in the previous legislation or the previous law was the highest tax rate was 39.6%. So that's that right there. It's a benefit of 2.6% for those high income individuals. Then I was going to talk about the standard deduction. So when we calculate our taxable income, there are individuals, we have 2 sorts of deduction. One is the standard deduction or the itemized deduction. Whichever is higher is what we take. The standard deduction was almost double. In the case of single taxpayers, the standard deduction is $6,350. After tax reform, the standard deduction is now $12,000. So it increases. In the case of married filing joint tax returns, the standard deductions before was $12,700, and now with the new legislation, it increased to $24,000. Important to note that the personal exemption, which is a deduction that you claim for every person that you report in your tax return of $4,050 per person, was eliminated. So it was embedded as part of the standard deduction.
Okay, great.
So if we're a taxpayer and we don't claim the standard deduction and we itemize our deductions, there were 2 very large changes that impact the people that have real estate. So for example, first is the mortgage interest deduction. That is usually the largest itemized deduction that we as individuals claim when we file our taxes, right? So the change was that before, loans of up to $1 million, the interest on those loans were deductible for acquiring that property. Now that $1 million was reduced to $750,000 for newly acquired property for loans after December 15. So there are grandfather provisions for those loans that were acquired before this date. So if you acquire your property before December of 2017, you're grandfathered. Okay, so you don't have to, the rules as the prior law still applies to you. For property acquired after December 2017, that's where the new limitation kicks in. Another big change was the deduction on state and local and property taxes. And this was very well discussed, and it was there were very vocal discussions because the high tax states such as New York, New Jersey, and Connecticut get impacted by this. In the past, the state taxes and local taxes and real estate property taxes that you paid on your property were deductible as an itemized deduction. Now there's a cap of $10,000 combined. So that's a pretty large limitation, since most of us that owns the property and pay real estate property taxes, most of them are in excess of 10,000,
Right.
not counting the state taxes. So this is a pretty hefty limitation that is going to impact a lot of the people that owns a real estate property in New York and in the country as well.
Of course. Yeah, because now your role of affordability is sort of compromised there.
Well, at the end of the day, it's going to be an exercise for each and every one of us how we fall under this new legislation. So the rates came down, but the deductions were a little bit limited in the case if you own real estate property. So again, you should discuss with your tax advisor to see where you fall in all these changes, right? Because you could be a winner or you could be a loser.
Right.
We don't know. Right?
True.
Again, it's just going to be an exercise of facts and circumstances of each and every one.
Everyone's circumstance is a little bit different. So
yes, exactly.
how does it affect you? Yeah, you have to find out.
So moving on, one other thing that I wanted to touch base was the exclusion for the gain on the sales of your principal residence that was on the table when we discussed it, that they wanted to change the holding period of you living at least 2 out of the last 5 years that you own the property in order to qualify for the exclusion. That's no longer in the table, so the rules remain the same. As long as you live 2 of the last 5 years in your principal residence and you sell it, if you're single, there's an exclusion of $250,000 for the gain, and if married, filing a joint return, there's an exclusion of $500,000. That's still the case. That didn't change. But I wanted to note it because we discussed this in our previous discussion. Now, in the case of businesses, corporate taxes for regular corporations decreased significantly. Before it was 35%, now the rates came down to 21%. So corporate taxpayers are big winners out of this legislation. So if you have a real estate business that it's incorporated as a regular corporation, those are good news for you.
Yeah.
Right? Then one other item that could be very significant and helpful for real estate investors is the 100% expensive of certain business assets. So what is this? This is called bonus depreciation. So in the past, there was 50% allowed as a deduction in day one for certain qualified property. This now changed to 100%, but it's temporarily. It's going to be starting to be phased out after 2023. But still, in these years, what this means is if you have qualified property that its recovery period is less than 20 years, you can take full 100% of that expenditure as a deduction in day one. So if you buy a property that costs you $1 million and you're going to depreciate its useful life, it's 10 years, so you're going to take let's call it $100,000 depreciation every year. What this allows you to do is take that $1 million as a deduction in year one. Right. So if you're making significant acquisitions or of qualified property, that it's going to help your business. It's going to lower your tax payment for the current year.
Of course, I mean definitely a great advantage there.
Yes.
What sort of properties would, in a sense, qualify for this?
As I was saying, it's a qualified property with a recovery period of less than 20 years. So rental properties, right? Those of us that, not me, but our listeners that owns rental property and they need to buy equipment to, for example, the fridge, the stove. Those kind of property will qualify, and then instead of amortizing that over the useful life, let's call it 5 years, just to make up a year, and a recovery period, you can deduct the cost of that property in year one. So this creates a good environment for investment in this new rental properties, because it provides advantages to owners and investors to claim to accelerate the deduction on these items.
That sounds great.
Then I wanted to touch base too on the flow-through entities, such as partnerships and S corporations, which are very common in the real estate market. There are changes and good changes for this kind of entities where these entities doesn't pay taxes by themselves. They are flow through, so their owners are the ones that pay taxes on the income of the entity. And there is a new deduction of 20% on the qualified business income of this entity as a deduction for the owner. So for example, if we make $100 on one of these flow-through entities, let's call it that is our qualified business income, there is a deduction of 20%. So right off the bat, you pay taxes on $80 instead of $100, which that's a good change that help business owners that use this type of entity. And one thing that people, that some entities or businesses will not be able to take disadvantage is certain service businesses, such as attorneys and accountants.
Right.
So unfortunately, in my case, I won't be able to take advantage of this, but they did mention that engineers and architects are not services that will be limited, so they will be able to take the benefits of this provision. So that's good for the real estate market, because that incentivize this service, this type of services. And there were many other changes to the legislation, but I wanted to keep this short and really to the point of the things that investors as well as homeowners would like to know, the salient points, the most important things that they should keep in mind. But definitely, this new legislation opens the door for many opportunities. Yeah. My advice, Randall, is for all the people that are listening to this, they should contact their tax advisors to take advantage of the benefits of this legislation, or to minimize any risk exposure that they may have that they haven't really figured out. So again, my advice, consult with your tax advisors, because changes, very big changes that impact each and every one of us.
Yeah, that sounds great, and I think you pretty much covered it all. Of course, if you need more information on the taxes or just want information from a professional CPA, you can also reach out to Josue from Rivera and Montes PLLC, and they're here to assist in the whole process and explain the new tax law to you, because I know it is very complicated if you don't fully understand it.
Yes.
But of course, we're here to simplify for you as well. So Josue, thanks again for taking the time and for breaking this down to us.
Yes.
All right, and thank you for viewing.
Thank you.
Thank you.
Thank you for viewing. Visit my website for more information or subscribe to my YouTube channel.